things as we go forward. We're going to be talking about the new pass-through entity income exclusion. And when those of you that went to the seminar that I did earlier know that I specifically excluded this from that discussion because I think it is the most complicated, difficult thing we can do here. Here's the legal disclaimer that the firm puts in, and that's fine. Down the bottom it says, I am a CPA, I'm still a licensed CPA, and I am a retired partner at Gray, Gray, and I live up in the mountains of New Hampshire. I live in Waterville Valley, and I look up my front area right down the 8th fairway at Mount Osceola, and it's just spectacular here today. That's a picture of me a long time ago. And on there is my cell telephone number, my Gray email address, and my personal email address. I check my both my Gray and my personal email addresses at least once a day, regardless pretty much where we are in the world when we're traveling. So you can reach me that way. If we are here, if we're in the United States, I always have my cell phone with me, so you can reach me that way. The tax people at Gray are also fairly conversant in this, and you can always ask them a question and they'll be happy to help you. Okay. As I mentioned, this is by far and away, the most complicated portion of the new tax bill. And the complexity of it is mind-boggling. The math calculations are brutal. However, as we go through this, what you're going to hear is there are some decisions that you should be making, or at least those of you that know me know that I believe that the only bad choice is the one that you haven't even considered. You have to think about a lot of things here, and whether you want to do it, don't want to do it, whether it's good for you, bad for you, good for your firm, bad for your firm. These are all the things that you're going to have to think about. But just understand the complexities, and you'll see the complexity as we move on in the next hour or so. I want to warn you. There is a tremendous amount of information about this particular tax provision out there. Not all of it is accurate, and I'm not going to tell you which one specifically, but there is one article that specifically that was in Forbes online. I happen to know the author. He is more than an acquaintance, less than a friend of mine, and I read it, and after I finished reading it, I emailed him and I said, where does this come from? And he came back and said, oops. So just be very, very careful about what you read, what you hear at a cocktail party, what you hear at a bar, what you read almost anywhere from almost anyone is not necessarily true. So be very, very careful, and make sure that you follow up with people that you trust in something that you hear in this area, because it is just brutally complicated with lots of bad information. Okay, those of you that came to my webinar, I guess it was in December, when we talked about the new audit provisions for partnerships, said we had an opportunity because they were only proposed regulations. Those regulations are now final. There was very little change, so that was good, but we did. We have an opportunity here, and the opportunity we have is this is brand new tax law. There are no regulations to clarify it. There are no court cases settled to do anything with it. So that within certain parameters, all right, we can do certain things. Now, I've taken some liberties, very few, as to what was here, because with a couple exceptions, this one is, although it's very complex and in some ways, I hate to say it's nonsensical, but in some ways nonsensical. I pretty much followed as is written. All right. So we expect to see a lot of regulations. We expect to see court cases, but they could be years away. However, one of the things that is not years away, and in discussions that I had with some people that I work with in Washington, D.C., that I help in Washington, D.C., there are some things in this particular provision and other parts of the law that are not doing that which was intended. And, you know, they're just technical errors. But those technical errors can be glaring. So that we expect a Technical Corrections Act sometime in the next 6 to 8 months. Now, does that mean it's going to happen? We don't know. What's going to be in it? We don't know. But we're going to be keeping track of that. I have friends down there that are involved in drafting this. So we'll see where they are. I don't think anything substantial is going to change in this case, but I could be wrong. All right, I want to take care of a couple of housekeeping things. For simplicity's sake, what I've done here is I have only included one business. All right, theoretically, if you have multiple businesses, all right, if you have 3 S corps flowing into your tax return, you can have all 3 flowing in, and they're going to be combined together in the whole discussion. I just didn't want to push that math. But you can do it. If you have that situation and you want to talk about it, you know how to reach me or reach somebody in the firm. I use the term partnership. That is the term that they use. It also applies, obviously, to an LLC or LLP taxed as a partnership. I also use the word proprietorship because that's what's used. That would also apply to a single member LLC. Some people asked, and some people actually submitted a question about this, and I have other people asking me this question: how are you going to get this information if you're an investor? And the answer is, we don't know exactly what's going to happen, but there's going to have to be a lot more information provided to you, the investor, on your K-1s. Exactly how it's going to be there, we don't know yet. The IRS is trying to figure out that drafting. They have a year to worry about it, but they know that they have some real drafting headaches ahead of them in order to get all the information, and it's a tremendous amount of information you'll see that people are going to have to get with regard to this particular provision. Okay. One of the other questions that people have asked me is that, do you have to be an active investor? And I don't want to get into the whole definition of active, passive, and everything else. We'll be here until dinner time. But basically, an active person is somebody that's regularly involved in the business. A passive person isn't, and that's the simplicity of it. It doesn't matter whether you're active or passive. If you receive a K-1, if you are a proprietor, it doesn't matter how much time you put in. This will work for you. That's the simplistic answer to that question. All right, the general rule is that you can deduct 20% of your qualified business income. So that basically, and we'll go through the example, if you have $100,000 of qualified business income and you don't exceed thresholds and everything else we'll talk about later, instead of $100,000 worth of income, you have $80,000 worth of income. Just that simple. It does not include, all right, certain things, but this is the definition. It is the net amount of income gain, deduction, and loss with respect, and I put this in red because these are important terms, a trade or business. Now, unfortunately, the term trade or business is really not well developed in the legislation. We'll talk about what it does a little bit more, but it's not as developed as we would like to see, but there are a couple of things that we know are going to be different. So it's any trade or business, all right, other than the specific trades or business that we'll discuss later. And these are service business. These are personal services business. all right? And you're going to see about them, and there's one right at the end that's a catch-all, because I love catch-alls because we don't know what they mean. But we're going to be talking about that specific area because it is not as onerous as people have made it out to be, but it is pretty onerous. So that basically the service businesses, the personal service business, are not treated the same way as everybody else. They are treated much more harshly, and a lot of things they lose out on. Okay, this is important, and it is very important to realize the fourth line down. We talk about 20% of the aggregate amount of a qualified REIT, real estate investment trust, dividends, and qualified publicly traded income partnerships. So if you invest in those, and I know a lot of people invest in REITs, my magnificent wife and I have investment in several REITs. If that is the case, then what you're going to have is you are going to be able to take 25% of the dividends you receive as a deduction. Why is that important? That is important because what it demonstrates is that real estate is not excluded by definition. And that's going to be really, really important as we move down the line and talk about some other things. Excuse me. So qualified business income does not include, that's my little minus sign, capital gains or losses, dividends, interest income are generally excluded. All right. Now, I always love the word generally. The biggest thing where it's not included is if you own a business and sell it. But aside from that, what this really says is that it excludes mutual funds, it excludes most types of hedge funds, are not included because these really are not business per se. Okay. The other thing, and this is something that people are now going to have to pay very close attention to. Anybody that's out there and is in the real estate business is going to have to understand this. Triple net leases, all right, where basically you're saying, here's the property, you take it, you run it, you insure it, you do everything. I wipe my hands, all you do is send me a check. I have zero responsibility for it. When that is the case, the 20% does not apply. So basically, people are going to have to take a long, hard look when they're doing leases now as to whether or not they want to be in a position, because a lot of people sit here and say, I just as soon say, here, whomever, here, IBM, for example, you take my building, you do everything, you just write me a check, I have nothing else to do with it. That would be a triple net lease. All of a sudden, that's not going to apply. So people are going to have to take a long, hard look as to how they're setting up leases if they want to be involved in this. And that's something people are going to have to understand. Okay. We're now going to get to one of the fun parts. If you know, excuse me, I'm a very strange person, so I think things are fun. And you'll notice I put it in red because this is going to become really important, and people are going to have a real problem with some of this. Also excluded from qualified business income is employee compensation of an S-Corp shareholders, and guaranteed payments for services to a partner are excluded. Now, I don't want to get into a whole great big discussion about with regard to guaranteed payments to partners. When is it a guaranteed payment for a return of capital? When is it a guaranteed payment for past retirement? When is it 80 other things? Basically, the simplistic answer here is that does it apply for self-employment income? But before I get too deeply into that, we have to remember something. We've talked about this in other seminars, and that is S corporations require, big word, it is an IRS requirement that an employee shareholder of an S corporation must get reasonable compensation for their services. Okay, Mike, what's reasonable compensation? The answer is, I don't know what is reasonable, but I usually know what's not. I know when it's not reasonable too high, and I know when it's not reasonable too low. And in this situation, we're going to talk about when do you do it, what don't you do it, and what's the effect of it. And you're not going to be really happy when you see what the effect of this reasonable compensation could be. Right? Guaranteed payments are an entirely different story. There is nothing in partnership tax law that says that a general partner, a managing member of an LLC, taxed as a partnership, or anyone else receive guaranteed payments for their services. Now, people are going to say, wait a minute, but we do that. Hang on, somebody is writing me a very long questions here. Just a second. I'll go back to it in a minute. So basically what we do very often is we have a guaranteed payment for services and so on. Let me go read this question. For 199 deduction, can a spouse's wages as a taxpayer's office manager be added to the qualified business income for the taxpayer's Schedule C chiropractic business? Far below the phase rate, if not, ways to overcome. All right, so the question is, if you have your spouse, all right, and I think they said this was a proprietorship. Can you pay your spouse a proprietorship? The answer is yes. Nothing has changed in that area that you can do it. I will tell you that the IRS is looking very closely at that situation and what they can do. But I mean, you know, I'm not sure what accomplishes what you're trying to accomplish by paying your wife if you're below threshold. But you know, that's something I think you should call me. We can discuss. For the 198 deduction, can spouse's wages and office manager far below threshold if not? You know, the question that somebody's asking is, can I pay my spouse out of either out of a proprietorship and have it not be involved in qualified business income? You got to sit here and say, why am I doing this? All right, and you're not telling me why. The question you have to ask is, why are you doing this? Why are you reducing your qualified business income and reducing that amount? You know, to get your spouse. You know, the other thing I have is many people think that they should be paying their spouse for Social Security reasons. That's not necessarily true. There's a lot of things you have to do. I understand the question. I have to know a lot more information. So give me a call or send me a detailed email, and I will get back to you on that. Spouse wants to fund their simple IRA. Okay, that's great. So we're going to talk a whole lot later about whether this makes sense. You now have to sit here and say, okay, what you just did is you said, I'm going to take and fund my spouse's IRA and not get a complete reduction of qualified business income. Does that make sense? Maybe. Does a simple IRA make sense for people? Maybe. You know, there's a whole lot of questions that you have to do with regard to retirement planning and what people should and should not be doing. Will the recording for this be available later? I'm assuming the recording for this is going to be available. They always are. So I'm assuming that Laura and Laura are taking care of that back in the office. So that's enough about guaranteed payments. The whole question here is for the owner operator, the employee, shareholder, the proprietorship. What do we want to do, and what is self-employment? Do we want to pay self-employment tax, or do we want to get a deduction and get an exemption? And let's take a quick look here. A business has $250,000 of business income, and we're going to assume there's no other income. All right. Sole proprietor, partnership, husband and wife, taxes, husband and wife, LLC, taxes to partnership, and a single shareholder S Corp with reasonable compensation of $100,000. All file married filing joint. Make my life simple. So here's our example. okay? My partnership, my proprietorship has $250,000. My partnership has $250,000, and my S Corp has $250,000. But my S Corp pays $100,000 of reasonable compensation. So what happens? I get 20% of each because I'm less than the threshold. We'll talk about threshold in a few minutes. So my proprietorship has a $50,000 deduction. They're only taxed on $200,000. My partnership is only taxed on $200,000. But wait a minute, my S Corp only gets a $30,000 deduction. So the S Corp, including the shareholder salary, is going to be taxed on $250,000. So let that sink in for a minute. Basically, what has happened in this case is that the choice of entity, the entity that you use, is going to affect how much your exclusion is, okay? So go back to my other person's question where he wants to pay somebody a salary. Well, he's paying them a salary, okay? It's not to him, it's to somebody else, but it's still lowering that income down, so you're lowering your exclusion. Which is more important, your IRA or whatever? Wait a second. You didn't say anything about guaranteed payments to members. A member is no different than a partner. There is nothing required, unless you put it in the operating agreement, to pay any member a guaranteed payment. It is up to you. All right? I know we've been doing it. I've recommended it. I still recommend it. However, it's not required. There is no requirement to pay a guaranteed payment to a general partner, a limited partner, a managed member, or a non-managing member. All right? That doesn't mean you shouldn't do it. There are lots and lots and lots of good reasons for doing lots and lots of good things. However, do you want to do it? And we're going to show other examples. Do you want to do it and lose the exemption? All right. So basically, what I keep coming back to, and I've only got an hour, but what I keep coming back to is this is tremendously complicated. You have to sit down and figure out, what do you want to do? All right. What are you willing to live with? Do you want to maximize the exemption or not? All right. So you're now yelling at me, this isn't fair, all right? I'm sorry, what is the expression? Life's not fair. Tax law in this case isn't fair. This was the way it was designed. Will it be changed? Maybe. Be very, very careful. Several of the articles that I know specifically are out there say that, well, Congress couldn't possibly mean this, therefore we're going to ignore what the actual law says and do it some other way. Please don't do that. All right. The law is this way. This is the way it is unless or until it's changed. Yes, Mike, it's not fair, and some other things we're going to talk about are equally unfair. So let's take example number 2. A business has the same $250,000 worth of income. I have a sole proprietor, husband who I tax a partnership. Except in this case, the partners take guaranteed payments of $100,000, and the single shareholder of the S Corp takes $100,000. And again, they're married filing jointly. And look what happened. All right? In this case, the partnership's guaranteed payment does the same thing. That's interesting. I just noticed the typo. Do the same thing as the S Corp. So in this case, the proprietorship comes back. Okay. So again, this is really, really important that we're going to have to sit here and say, okay, do I want to take, forget S Corp for a minute, but as a partnership, as an LLC tax as a partnership, do I want to take guaranteed payments, which gives me Social Security, gives me the ability, depending if I have a 401k, to put money in a 401k. Do I want to do that, or do I want to maximize the amount of the income exemption? This is something that, don't come to me, don't come to somebody, in February 2019 and say, oops, I didn't really mean that, okay? Quick, read your unread chat message. Okay. So that's one of the things we have to talk about and have to be very, very cognizant of. Phase outs, all right? We're not going to talk about service businesses for a second, but these are the phase out percentages, and the phase out percentages are not based upon the amount of qualified business income that comes through, but rather the amount of your taxable income, okay? So basically what we have is that we have, for single taxpayers, we have $175,500. For married filing jointly, we have $315,000. And basically that, and then it phases out for the next $50,000 of taxable income for single and $100,000 for married filing joint. Just more and more math that people have to think about when you're doing things. Now, one of the things that I really like here, let me go back for a second, is people have talked, I talk periodically about marriage penalties, where basically if people are married, they're in a less advantageous situation. That's not true in this case. You'll notice that for whatever reason, this actually came down and said, yeah, this is exactly where we want to be, okay, with no marriage penalty. Now, we get to some other fun. You've exceeded your threshold. You've done the math and you've exceeded your threshold. So now what happens, all right? And what we now have is a very interesting situation. You have the lesser of 20% of your qualified business income, if you know how to do that calculation, or the greater of 50% of wages paid, or 25% of wages and 2.5% of the unadjusted basis of assets immediately after acquisition of all qualified property. This comes back to this last bit of 2.5%. We now get into the area of real estate. So basically, all right, and we'll talk about a real estate example in a little while, but basically this comes back to saying, okay, there actually still is a way that real estate can benefit from this, all right? Even if you have a lot of, if you exceed the threshold, all right, you don't have a lot of wages, all right, if you own real estate and you've hired somebody to run it for you, all right? So you don't have a lot of wages, you don't make the 50% wages, you don't make the 25% wages, but you can still get 2.5% of the basis of your real estate, which can be substantial. So basically real estate can get involved in this as long as we avoid the triple net leases, number one, and we understand how to do this calculation, which just gets more and more complicated. All right, I said we talk about personal service entities. Let's talk about them, all right? Health, law, consulting, whatever that is, athletics, financial services, brokerage services, or any trade or business is the one I like, or any trade or business based upon personal reputation. Right? Now, I have a good friend up here in the Valley who is a personal trainer out of the gym up here. And, you know, we were talking one day, I was kidding around with some of her little girls, and she said, well, Mark, I think I qualify for this new 20%. I mean, you know, we don't make a lot of money between my husband and I, you know, we're way under this number or whatever it is. And I said, well, you know, that's a very interesting question. I would say that you don't. And the reason that you don't, and this is just me, whatever, I'm not giving you final advice, that's up for your accountant to do, but people come to you based on your personal reputation. You go to a personal trainer based on your personal reputation. You go to other things based on personal reputation. So that catch-all at the end is going to require an awful lot of looking at and figuring out what that means. But it's really important. And the reason it's important is because if you are in one of these personal service entities and you exceed the threshold, you get nothing. So if you're in a law firm and you get $500,000 of what you think is going to be qualified business income, you get nothing because you've exceeded the threshold, and the threshold for these businesses say you get nothing, right? So when you hear people complaining that the personal service industry's got a raw deal, I'm not saying they do or they don't, but I hear a lot of complaining. This is why. You exceed the threshold, you get nothing, all right, for the personal service industry. But prior to the threshold, you can get something. So basically, this also comes down to, depending upon where you are in your situation, all right, towards the end of the year, you know, if you're at or near the threshold in one of these businesses, you're going to want to maybe take a hard line look on managing your income in order to maximize, in order to get this 20% deduction before it goes completely away for you. Once again, just more and more complexity, more and more planning. Okay, so we now understand the simple part. We understand how simple it is to get the 20%. Now, what is the term qualified property? Qualified property is any property held and available for use in a qualified trade or business. And remember what we said, qualified trade or business is just about anything except triple net leases, okay? And hedge funds and things like that, but they don't have a lot of that anyway. And it's used at any point during the year in the production of qualified business income, when you wouldn't have the asset if it wasn't. And the depreciation period did not end over the course of the year. Those are the rules. That's what qualified property is. Is the calculation complicated? Yeah, it's a little bit complicated. Now, when you sit here and you say, okay, let's assume that for some reason we're going to wind up having to use this 2.5%. Is that going to make a difference as to when you may or may not buy a particular asset towards the end of the year or the beginning of the next year? Yeah, it might. So once again, it's just more and more planning, more and more things that you have to pay attention to if you want to maximize this income. And you know, long ago when I used to do year-end tax conferences, I used to say, I love tax-free income. All right, this is tax-free income. All right, so this is something you have to pay attention to. There's an awful lot of planning that's involved here. Here's my qualified property example, and Tom owns commercial real estate and has a management company to run it. He has no payroll. He has a management company. That is not a triple net lease. He has a management company that is responsible for going out and making sure the trash is collected and all the rest of these things. He isn't paying them. They're part of his management fee, but it still qualifies. Let me repeat that. He's got a management company to do this, separate management company, not his management company. He has no payroll, but it still qualifies. So he has $1.5 million worth of income, has great real estate, and the property has a basis of $2 million, just because I can only do just so much math. So we're way above our threshold, okay? So the deduction is the lesser of $300,000, which is 20% of the $1.5 million. He doesn't get that. Or $5,000, which is 2.5% of the $2 million. So basically, what we're saying here, and I know the numbers don't work and everything else in real estate. I do understand that. I was just putting numbers together for fun. Real estate can take advantage of this, all right? Do you want to have triple net leases, or do you want to be hiring management companies? What do you want to do? Once again, there's an awful lot of things that you have to do here in order to take a look at this, understand this. Where is it coming down? How is it coming down? I'm trying to pay attention to my little watch here. Okay. Qualified property example number 2. Lucy owns a printing company. She has income of $500,000 over the threshold. Has payroll of $160,000. She buys a new machine for $100,000 to replace all other equipment. Okay, so let's take a look. The $100,000, all right, doesn't get for the $500,000 because it exceeds the threshold. Then we have $42,500, which is 25% of $160,000 and 2.5% of $100,000. Okay, following the math here. However, she gets 50% of the payroll, or $80,000. So basically what we have is she gets the greater of $42,500 or $80,000, as long as that, and the lesser of that are and $100,000. All right, the math just keeps getting more and more fun. Okay, the planning here is important. This is free money, and free money is things that you have to pay attention to. Okay, example number 3. A business has $600,000 of business income, sole proprietor, husband and wife LLC taxes a partnership, and a husband and wife shareholders with reasonable compensation of $60,000 in the S Corp and a similar guaranteed payment. Right? Other payroll is $50,000, and I have equipment of $100,000. I do everything married, filing joint, just because I am. So let's take a look, okay? We have an S Corp here, okay? So I wind up with qualified business income of $540,000. I have payroll, other payroll of $50,000. So I have total payroll of $110,000. Because I have total payroll of $110,000, I get 50% of my payroll. That's $55,000. I have a proprietorship. Okay, I have no payroll. Okay, $60,000 doesn't count. My payroll here is $50,000. I get $25,000. The same with the proprietorship. So in this case, all right, whereas in the previous case the S Corp had less advantage, in this case the S Corp has greater advantage. So basically what I'm saying, and I know this is incredibly confusing. It was confusing to me just as I wrote it. This is cannot overemphasize how complicated this is, how important it is to sit down with your tax advisors at Gray, Gray & Gray and say, okay, this is where I think I'm going to be. This is what I want to do. Where does this come down? And push the numbers and see that, make sure your choice of entity, and you know, I talk a lot about choice of entity. Make sure that your choice of entity in this situation still makes sense. All right? I'm not telling you what to do. I'm not telling you to change from one to another. There are lots and lots and lots of good reasons for having your choice of entity in the flow through entity arena. But I want you to understand the consequences and understand the free money that's involved. I'm going to try and leave 10 minutes or so at the end for questions. Now, you're sitting here and the steam should be coming out of your ears, all right? This can't be right. Why should one entity benefit so much more than others? And specifically, the biggest question and the question that people have been harping on me is that it cannot be right that a shareholder salary, all right, from an S Corp, which must be reasonable based upon tax law, there is no question about that, it must be reasonable, is different from a guaranteed payment that is not guaranteed. There is nothing guaranteed about it unless you make it so in your operating agreement. There is nothing in tax law that says that guaranteed payments to someone performing services in a partnership has to have a reasonable compensation. Nothing says that. We like to do it. We think it's common sense, but whatever. And this gets into the whole list of questions that we're going to talk about briefly, because it just is mind-boggling, the amount of questions that that are going to be asked here. Choice of entity, choice of entity, choice of entity. Understand where you are in the threshold determination. Understand where you are in your guaranteed payments. Understand where you are if you're in an S-corp environment, what your payroll should be. Okay. There are some really interesting articles out there. I am a very, very, very happily married man to the most wonderful woman in the world. And I always believe that you should do married filing jointly, except when it costs you a lot of money. And in this situation, and I didn't do an example because I knew I'd be running out of time, but it's pretty easy to come up with an example that says, wife has business income of $100,000. Husband has other income of $400,000. If they do married filing joint, they're going to lose out on a lot of things because it's going to be over the threshold, depending on all kinds of other situations. However, if they do married filing separately, husband's going to get a $20,000 exemption. Does that make sense? I didn't say any of this made sense, all right? But it's one more thing that you have to think about and one more thing you have to talk about in planning. I have to put this warning in here because it's right in the law. Tax law says that if you have a 10% or greater understatement, you get an accuracy penalty that hurts a lot. However, if that accuracy penalty is caused by this, it's not a 10% threshold, it's a 5% threshold. So that what this does is this takes all of the complications that we've been talking about, everything that sits here and saying, this is so complicated, how am I going to be able to do it? And say, wait a minute, you don't have a 10% leeway, you have a 5% leeway before that penalty kicks in. So that's just one more thing that tax preparers and everybody else has to be very, very cognizant of. All right. A lot of the discussions that I've been having with people say, well, but Mike, if I don't take a guaranteed payment out of my partnership, all right, I'm not going to be able to be in a 401k. Well, okay, which is better? And I'm not saying I know the answer to this, but which is better? Free money, non-taxable money, or money that you're going to put into a 401k? It is going to grow tax-free, that's true, but when you take it out, you're going to be taxed on it. On one side, you get money, that $20,000 you put in there, that you put into your investment account, that $20,000 is never taxed. On the other side, you put $20,000, and let's say you can put $20,000, I know you can't, but let's suppose you could put whatever money is involved into a 401k, into a SEP, IRA, into whatever it is, and it winds up being taxed when it comes out. Which is a better retirement vehicle? Once again, I have very limited time. I can't get into it a lot more than that because I want to set aside a lot of time for questions, and basically we're running up against the 10 minutes that I said I would allow at the end for questions. This is something you must consider, all right? Which is better? Which is better for you and for your family? And it is not a simple situation. You really have to sit down and you know, I'm old, and I still say push the pencil instead of use the Excel spreadsheet. I do use the Excel spreadsheet, But you really have to sit down and figure out which is better. Is it better to take your, to use the number, $10,000 and put it into, and I apologize, I use Fidelity, but you'll put it into your Fidelity account, and when that $10,000 comes out after whatever number of years, all right, it is still tax-free. You will never pay tax on that $10,000. Or are you better off putting that $10,000 into an IRA and having it grow that way? You got to sit down and push that number and figure out which way you're actually better off. I understand the importance of a 401k and an IRA and forced retirement. I understand all that. I understand that for many people, putting it into a retirement plan where they cannot get at that money and do whatever with it, I understand that. I understand the importance of that. That's a consideration. There are many, many considerations that people have to think about in this case because of the case of free money. All right. Let me go back in and open up the old question box. Okay. Are service aids excluded as personal? Yes. I'm going back up. I thought shareholders are added back. I don't know what added back means, but they are deducted, all right, from QBI. So that basically you take your initial amount and you're adding it back when you add it back as salary for the 20%, for the 50% later. I think that's what you're talking about. Guaranteed payments to member, okay. But basically, I'm not sure what you mean by added back. Are they added up? No, they're not added up to determine the amount. All right. Is the phase out only for No. The phase out is for everyone. All right. So basically, everyone gets phased out based upon the situations that I showed. What the difference is that if you're a manufacturing company and you manufacture widgets, right, and you're at $500,000, okay, you exceeded the amount, that's fine. However, you're now going to be able to go and take 50% of your payroll. If you're an accounting firm, law firm, doctor, as soon as you exceed that threshold, you're out of luck. You get nothing. Right? That's why people say that it is unfair to the service businesses. Okay. Are CPAs excluded as personal service residents? Yes. When would someone at GGG tax department be knowledgeable enough to recommend to me if I need to change my operating entity? I would say that they can do that now. You know, if there's something they need, they know where to find me if they need me to be involved. I want to emphasize here, changing your type of entity, going from a partnership to an S corp or an S corp to a partnership, or going from a proprietorship to an LLC. This is not something you do on a whim. All right, this is not something you do just because of a short-term gain. Choice of entity is a long-term, complicated thing that you have to do. There are plenty of people at Gray that can help you with this, but it is not a simple situation. It is not something you do based because it's going to help you for 1 year, and you really have to sit down and understand it. Also understand whether or not there's going to be a taxable event because of your change. So yeah, there are plenty of people at Gray that can help you, and if you ask them a question that they're not comfortable with, like I said, they know where to find me. Royalty and licensing fees. I've seen two answers to that question, and the question with royalty and licensing, and I want to see if I can go back here to my favorite slide. All right, this is my favorite slide. all right? And it's because it's the after the comma or any trade or business based upon personal reputation is a royalty or licensing fee based upon your personal, big word, personal reputation. I have a company, all right? I have 5, 10, 25, a million people that work for me, and because of what we did, we were able to do something, and we licensed it out. See, I watch Shark Tank too. We licensed it out, and I get a royalty or a licensing fee. In that case, it is not my personal reputation. This is something I concocted down in my basement, just me as a proprietor. In that case, I'm not so sure. And a bunch of my friends and I have thrown that around. That is one we're going to have to wait and see. I would take it, but be aware that if it is just you, that may be an aggressive position. Is there anything that can be done to offset the loss of miscellaneous deductions like investment manager fees? Well, that's an entirely different discussion with regard to the loss of miscellaneous itemized deductions down on your investment fee. Is there anything that can be done about it? Not really. I don't know of any that can be done. So that basically those management fees for your investments starting this year, 2018, are pretty much lost, along with a whole bunch of other deductions. So that, you know, there's not much you can do about it. I mean, you can talk about how you do it and what you do with now with the increased standard deduction compared to itemized deductions, and when you do it with deductions that are left, but there's not much you can do there. Where will this deduction show up on an individual tax return as a line item? That's a great question. The IRS hasn't asked me to prepare forms, but I would assume that this would be on page 1 below the line somewhere. That's where it would be. Either that, or it might be on page 2 on the back. But I'm not sure where they're going to put it. You know, but that's just a forms question, and they have all kinds of problems figuring out how this is going to change K1s and all the kinds of rest of the tax returns, because remember what I said, this is a function of taxable income. So basically you have to figure out what your taxable income is to figure out what this is going to do to change your taxable income. And I recognize that as a circular logic, but that's the way it's set up, which is kind of interesting. If a lot of my single member LLC treated as an S Corp income from management or sale of real estate development, is that excluded? Let me see if I can read that again. Wait a minute. If a lot of my single member LLC treated as an S Corp, okay, income is from management of real estate development. Now, if you have management of real estate is a trade or business, okay? I don't care whether you're managing your own real estate or somebody else's real estate. Management of real estate is clearly a business. The only thing generally in the entire real estate world that I think is totally excluded is, like I said, triple net leases. And you know, people are going to have to go and figure out what they want to do in that area and to get this and not get this. So non-LLC sole proprietors are not eligible. What does that mean? Non-LLC sole proprietors. Well, no, a sole proprietor is eligible. Go back to my examples. All right. All right, there's my proprietor. The proprietor is eligible as long as they fit in the world. And a single member LLC proprietor is absolutely eligible, just like anybody else. So there's nothing to stop them from doing that. I'm sorry if I misled you on that. Proprietors are eligible. Single member LLC is a proprietorship. Would a staffing firm be excluded. There is nothing in the rules. There is nothing in these rules that say that a staffing firm would be excluded. I don't think a staffing firm is financial services or brokerage. I don't think a financial service is a personal reputation. So I don't see any reason why a staffing firm would be excluded. I know some other people, some friends of mine around the country, we've kicked that one around a little bit. And generally, we all feel that there's nothing as it currently stands to preclude a staffing firm. Okay, oh, wait a minute. Performing artist, proprietor with, oh, wait a minute. So you said the magic word. I mean, the first two words, performing artist. I go back to my performing artist. Let me see if I can. All right, performing artist. Oh, I can't draw here. Performing artist. I think of a performing artist is personal reputation. I mean, if someone is a performing artist and you know they're being paid because of what they can do, whether it's dance or acting or singing or whatever else it is. I think a performing artist would be excluded, would be my answer. Can a taxpayer elect that investment management fees be added to the basis of securities? Wow, I never thought of that. I know of nothing in tax law, and this is not on point, this thing, but I know of nothing in tax law that would allow you to do that. But I'm going to think about that one, and you know, whoever asked me that question, send me an email, and I'm going to think about that. I'm going to talk that around with some friends of mine. Can't taxpayer elect that investment management fees be added to basis of securities, bypassing the elimination? That is true in some things, but not necessarily a management fee, for example, of just it depends what it is, a management fee of investment to an investment. How are you going to take the investment management fee of an investment portfolio, and who are you going to apply to acquire across the board? I think you have a problem with that. What happens to charitable donation deductions after the phase out? Charitable donation deductions have nothing to do with what we're talking about. I mean, oh, you're talking about the question of the 50 or the new 60%. We're going to need guidance on that as to which one it is. But my inclination would be that it is based on pre-20%, but that's going to depend on how they do it. I never really thought about that one. That's a good question too. There is nothing in the law that addresses that. All right. You know, so now we're going to have to wait. I hate doing this. I hate waiting and seeing how they're going to put the forms together, because just because the IRS does things in a certain way on forms does not make it tax law. But that's something we're going to have to wait and see see whether or not if they come up with regulations. I know that they're talking about that, but I don't think we have an answer to it. Can you confirm your understanding that architects and engineers do not? Architects and engineers, you'll notice in my thing here, architects and engineers are not listed. All right, so architects and engineers have a carve out, and there's a reason they have a carve out. Some people mentioned that this is Internal Revenue Code 199A. The old the old exclusion was 199, and architects and engineers said, wait a minute, we got a benefit for production deduction under 199, and their lobby came along and said, it's not fair to do that to us because we got it over here, therefore we should get it over there, and they were able to get it. Architects and engineers are excluded. They are not included in the listing. Is tax preparation fees considered personal services? Yes. Right off the bat, you've got financial services. Financial services include tax preparation fees. So if you're an accountant preparing preparing tax returns, I would say that you lose. That doesn't work. Professional photographer, personal reputation. Artist changes from proprietorship to S corp. Does it generate? I would say that changing your type of business does not change what your business is. So that I don't care whether you're a dancer, right? Whatever. That you're a dancer, whether you're a proprietor, single member LLC, or whether you're an S corp. I don't think it makes any difference whatsoever. Which one it is. I mean, so I think that's all entertainers fall into the personal reputation category. So I don't think that works. Mike, your discussion seems to have been all around change entity from sole proprietor, converting from an S corp to a C corp. The question is there I didn't mention C corps, and I didn't mention C corps that doesn't have anything to do with this situation. C corps have a flat 21%. Long ago, when I was young, and I would talk to people about choice of entity, and at that time there was a built-in gains law of 10 years. So when somebody said they wanted to go from an S corp to a C corp, I would carry, it wasn't a Bible, it was a notebook, but I would carry a notebook around and say, I want you to put your hand on my notebook and absolutely positively promise me that we're not going to have a sale of the business for 10 years, in this case now 5 years or whatever. I think C corps are just dastardly dangerous. There are reasons to be C corps. C corps can be very, very good tools. Is this a reason to go from an S corp or an LLC or whatever to a C corp and be taxed at the flat 21% instead of this situation? You got to be really careful. C corps. C corps are just so dangerous. Not only there, also if you're talking about going in succession planning and all kinds of other things in planning. I have never been a big advocate of C corps. I do understand now that C corps can very often have a tax advantage because of the flat 21%. You got to push the pencil a little bit. Yeah, you got to push the pencil a whole lot before you're going to have anybody tell you that it makes sense to be a C corp in today's world. But there are situations where it will. I was talking to a friend last night, and it absolutely will. But you gotta have. You should not, and this is very strange for a tax person to say, but do not let the tax tail wag the economic dog. You have to look at all of the economics that are involved in choice of entity and see what makes sense. And it is a very time-consuming, very complicated thing to do, but you have to do it. Is there a discount on the deferred tax liability one might be having played the cash basis game? You know, one of the other things, and it's not involved in here, remember that pass-through entities now can have up to $25 million of on cash basis. You got to take a lot of things into consideration. This is not simple. Advisor fees can be elected and allocated to basis, but I believe it's on a portfolio share basis. You can, it's just so complicated, and you have to see whether or not it makes sense to do. The other question that I always have is you really have to sit here and say, is all of the advice being given directly with regard to those securities, or is some of it retirement planning or something else? Has to be a lot of money before I would get involved on that. I'm at the end of the questions. I apologize. I'm 7 or 8 minutes over. I want to thank all of you. I have to now go to the end here because I went back. Once again, that's how you can get a hold of me. That's my cell phone number, which I almost always have my cell phone with me. I check my Gray email and my personal email several times a day. If you have to reach me, there are plenty of people at Gray that can help you with that. And if they have questions, like I said, they know where to find me, and you people always know where to find me, and you're always welcome to come up and look out at the beautiful mountains. This picture of Gray with the office number and how you can connect. There is the handy dandy disclaimer again, and there's my black screen. So I guess we are at the end. I want to thank all of you for participating. Again, this is just incredibly complicated. You really have to sit down with people that understand it and see how it is going to affect you and what do you want to do about it, if anything. Pay very close attention to the phase outs and plan for the phase outs and what you can and cannot do with them. So I guess that's the end. I want to thank everyone again.